standard costing. So far we've looked at direct materials and direct labor, and you'll notice there's a pattern there. We have a column for the actual cost, we have a column on the other side of the page for the flexible cost, and then we compare it overall, and we come up with the overall either material variance or labor variance. This time we're going to find the variable overhead variance overall, and then split it into its spending and efficiency variance by isolating a center column, which is the actual quantity at the standard cost. So notice that you compute materials, labor, and variable overhead all the same way, same format. So let's use exercise 11, which has to do with the service business. We're an architecture firm in exercise 11, and it says that we build clients for 6,000 hours. So is that our actual output? So we work 6,000 hours and build the clients for it. It also says that the actual variable overhead costs for the month were $315,000. So that's the actual. We actually worked 6,250 hours. So I could take 6,250 times something to get this. In our center column, remember it's the actual quantity, so it's 6,250 hours. Ooh, I can already see that we're going to have a variance because we only billed the clients for what? 6,000 hours, but we worked 6,250. So we have an unfavorable variance. I know that this is going to be just by looking at that. What else does it say? It says at the beginning of the year, the variable overhead standard was $50 per design hour. So the flexible standard, the budget standard, is $50. So 6,000 hours billed times $50 means that the flexible budget amount for variable overhead is $300,000. Notice we actually spent $315,000. So did we overspend what we should have? Yes. And we overspent it by $15,000. Now, is that favorable or unfavorable? Well, since actual exceeds the budget, it's big un. Now, we know some of this has to do with we didn't bill all the hours we worked, so we know this variance is going to be unfavorable. Well, I didn't put this 50 in yet, so let me explain this. Actual quantity, we said, was 6,250. Standard cost. What's the standard cost that we determined at the beginning of the year? $50 an hour. So if I take 6,250 times $50, I get $312,500. So this number in the center will allow us to isolate how much of it has to do with spending and how much has to do with not billing all the hours we worked. So 315 versus 312,500 says we have a spending variance. We overspent by $2,500. And that's unfavorable because the actual exceeded our expectations. When we look at the actual at standard versus the flexible, notice the variance here is $12,500. And it's unfavorable because did I, again, exceed my expectation. Why did we exceed our expectations here? Because we didn't bill the client for 250 hours that we worked. We only billed them for 6,000. So do you see how this helps you isolate the variable overhead variance into its spending variance and into its quantity or efficiency variance? Now the big question is, why?